Bloomberg Audio Studios. Podcasts, radio, news.
The Stock Movers Report, your roundup of companies making moves in the stock market, harnessing the power of Bloomberg data.
Let's take a look at some stocks on the move today. I'm Nathan Hager, joined by Bloomberg's Valerie Teitel, and the stock to watch this morning, Valerie, certainly is the Walt Disney Company. After earnings, a very interesting reaction to what the House of Mouse reported. Good morning.
Yeah, Disney on a back foot, down 3.1% after these earnings in the pre-market. The sales fell short of estimates, and they posted roughly flat revenue and a decline in operating income during the previous quarter. But another major worry for the path forward for Disney is expenses. The entertainment company said a slate of big budget films will weigh on expenses and results in the next quarter. They cited expenses tied to the release of Zootopia 2 and another Avatar movie will reduce earnings by $400 million. They also claimed that their theme park and cruise unit will have an additional $150 million in expenses in the first quarter tied to new ships and dock work. Still, Disney is predicting that the fiscal year 2026 earnings will grow by double-digit percentage. However, those gains are going to be weighted toward the later half of the year once these expenses are worked through. So Disney shares on a back foot after these worries over expenses, down around 3% in the pre-market.
Well, we're seeing a much more positive reaction to the results we got from Cisco Systems after the close yesterday, Valerie.
Cisco is higher by nearly 7% in the pre-market. The network equipment maker had boosted its 2026 forecast, Nathan, on the back of progress in capturing more of the AI spending. This has really been a make or break topic for tech companies this year on whether these businesses are in the right place to capture the AI boom. Cisco convincing investors it needs to rally another 2% today, actually, Nathan, to breach its dot-com high of $82 a share. We're trading at 79 at the moment, so watch out for that.
Speaking of AI, Valerie, quite the headline coming down on that story from Alibaba.
Yeah, we're seeing the shares of Alibaba head higher in the pre-market, up 4.2%. The Chinese e-commerce giant is preparing to overhaul its main mobile AI app to more resemble OpenAI's ChatGPT. The revamp is also going to mark Alibaba's biggest move so far to try to wring revenue from more consumer-facing services in the app, like adding agentic AI features, which is essentially having the AI do your shopping for you in a way to monetize the technology. They do want to turn it into a more fully functioning AI agent, and they do plan to eventually expand globally with an overseas version. So Alibaba ADRs headed higher after this announcement about their revamp, up 4.2%.
So after another sign of positivity around the artificial intelligence story, we're getting a flip side on the other side of maybe the K-shaped market from Dollar Tree.
Exactly. Dollar Tree is suffering a double downgrade from Goldman Sachs. The shares are lower this morning to the tune of 3%. They did cite concerns about the lower end consumer weighing on Dollar Tree's earnings in the coming quarters. Perhaps that is more evidence again that Wall Street is really penciling in a weaker lower end consumer versus a bustling top end consumer. Goldman Sachs was also citing a declining consumer perception around Dollar Tree's price and value of their goods.
The Stock Movers Report from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.